Hi, everyone. This is Rob Roy, and welcome to this week's U.S. Market Update. As we do each and every week, the stocks you see on your screen will be the stocks featured in this recording. And as a quick reminder, if there's a particular stock you're interested in, you can go directly to it using the chapters feature on this recording. Still up in the mountains here following the July 4th and my birthday holiday weekend. Thank you for all the well wishes. Appreciate that very much. It's been a great holiday week. There was some economic news to talk about this week. Obviously, we had the CPI report that came out on Thursday, and that was a lot weaker than expected. We'll get to the charts in a minute, but that seemed to put a little bit of a question in the markets, which I'll refer to here in a second. But then today, we had the PPI report. They came in slightly hotter than expected. So the CPI report was actually negative. That you thought would have been a great thing for the markets, but the markets went down on Thursday, and then we get a hotter PPI report today, and the markets go back up. So let's take a look at a chart of the markets and see what's occurred over the last couple of days. So when we take a look at the S&P, you can see we were down yesterday, and the question that I feel like that raised in the market was, is the Fed going to be too late to cutting rates? With the fact that the CPI report was actually negative, you would have thought that would have been a strong movement for the markets. We did open higher, but then we reversed and we actually closed lower. And then the PPI report oddly comes in hotter than expected, and we actually finished to the upside today to finish the week. So not really the movement that you would have thought. A lot of comments over financial media that the market doesn't really pay attention to the PPI report. They just focus on the CPI report. But I think that will matter if you're paying more on the wholesale level, on the producer price side, but you're not being able to pass those prices on to the consumer. That will compress margins and that will hurt earnings. But we may not see that till the next earnings cycle. We get into earnings cycle starting next week. It starts to heat up, and over the next couple of weeks, we'll have a lot of earnings, but those kind of numbers probably won't be reflected until the following quarter. And that kind of ties in with the theme that we're talking about as far as maybe this melt up into the election. And then we have a bit of a buy the rumor, sell the news after the election. The Fed starts cutting rates, and then perhaps we see some sort of a correction. So we're moving up in anticipation of rate cuts, but maybe once they actually occur, we get a correction. We are moving up towards the midpoint of this tap box. That's the time and price projection. You can see I've drawn a line right through where the midpoint is, where the wave 5 is. We're also approaching the 78.6% fib extension. Not a big deal in equities, but if you're a currencies trader, you're probably aware of the 78.6% fib level. That's to 61.8 as currencies are to equities. So basically, no harm, no foul. We recovered a good part of the drop yesterday, and we are still above the 10-day moving average. But we are getting to a point where I still think a little bit of caution is warranted. Maybe you're tired of hearing that because the market has gone up, kind of in a stair-step movement. We had this consolidation here at the end of April, then we moved up. We consolidated at the end of May, then we moved up. We consolidated at the end of June, and now we've run up again. Are we going to consolidate at the end of July? Are we going to keep this pattern going? As you know, markets do move in patterns. That's one of the great things about Elliott Wave, is it gives you a great indication of patterns. And by the way, if you're looking at the software and you haven't gotten a copy of it yet, go to hub.com, HUBB.com. It's in beta form, the new release. You can download it there for free. Nothing to put on your computer. It's just browser-based. So go get a copy of it. So we'll see what happens as we approach this midpoint of the wave 5. But I do think the melt-up scenario that we talked about last week is still in play. All right, let's move on. Let's take a look at the TNX, and boy, do we talk about the TNX a lot during Trade Finder. Interest rates have been a big subject of talk, with the fact that we've had an inverted yield curve for a couple weeks. So if you haven't joined us on Trade Finder yet, we do it at 1 p.m. Eastern Time, so it's now during market hours every Tuesday. We talk about the markets. We look for trade ideas. We have a live Q&A. There's a great community. They all interact, ask great questions. Love to have you become a part of that community, so you can sign up using the link on your screen. So please join us for next week's Trade Finder. All right, so going back to the chart of the TNX, we talked about this where we had the 100% extension. We retrace back, test the previous fib level. That's classic Elliott Wave zigzag rules to move to the next extended level, which would be 161.8. And interest rates are dropping below that 100% level, which leads you to believe that we may go to 161.8. I've been a little bit cautious on moving down that far. I know that you would think that rates going lower, that's a good thing for the markets, especially on the big tech stocks. But it also indicates the fact that the economy is weakening. And I think that brings in that question, will the Fed wait too long to cut rates? And I think that's a little bit of an indication of what's going on with rates. When we look at the dollar, you can see that the dollar has come down a bit. We're down here testing this 104 level now. Same type of scenario here. This kind of makes sense with rates going down. You would expect the dollar to go down, and it has. Now we'll see if we can hold this area. We're going to probably test this wave 4 low here right at the 61.8% level. Since that was kind of just one bar, probably makes sense that we come down and test that. We don't want to see the dollar go down too far either. Then that starts to mean that around the globe, they may be concerned about the amount of debt that we're carrying. So let's not get too weak of a dollar. I kind of want it to stay in this trading range that I've drawn here. I think that's the most ideal scenario. So we don't want rates to go too low. We don't want the dollar to go too low. The Fed has said they don't want to unduly harm the economy. But I think there's a little bit of concern about that in the markets right now, and myself included, because the Fed tends to be late to the party, late to cut, late to raise, and then they tend to go too far. And maybe they went too far on raising rates, and they'll be too late to cut rates and have to go a little too far on cutting again. Who knows? We'll play it out and see what happens. Let's look at some of our other markets. The DIA has gone up, and you can see we hit the 161.8% extension today. So this zigzag pattern where we bumped our heads right at the 100% level, then we turned and moved right up to 161.8 today. We did take out that wave 3 high. Now I had a question, what was going to happen then? Was this the end of the wave 5 and we retraced back to the previous 4? And was this the start of a new impulsive move? Well, not according to the Elliott Wave algorithm. And by the way, the algorithm that this software uses at Hub is programmed exactly to the algorithm as Ralph Nelson Elliott wrote it over 100 years ago. So it did move the 5. So I was wondering, would we start a new impulsive pattern, or would the 5 move over? Well, it's moved over. So we're still in the wave 5. The algorithm was holding this 5 here, and that's been in place so far. So that was one thing that was noteworthy to express to you in this recording. So now we've had the zigzag pattern hit the 100% extension, extend to 161.8. So that zigzag is done. We'll take that off next week. And now we'll see what happens from here. If we move to a new wave 5 high, what's going to occur on the DIA could also mean that that wave 5 now is officially over and we start down. So lots to think about on the down next week. Looking at the Qs, kind of came back down, which was a little counterintuitive yesterday with rates going down. You'd have thought, wow, we're going to have another big move up in the Qs. But no, we'd gotten a little bit overbought. The rules that we talked to you about week in, week out, vertical moves tend to get retraced, and they get retraced with more volatility, more than the 45-degree angle moves. And no security in any time frame gets too far from the 10-day moving average. Those are two key rules that you should incorporate in your trading, in my opinion. And that's what happened. We came back down to the 10-day moving average. We held it yesterday and today. A little bit of a move back to the upside, but not much considering the fact that rates are moving down. But we are seeing a broadening of the rally. And boy, it's not more evident anywhere than in the IWM. Look at that chart. We've been talking about this 210 level forever, it seems like. We had a trading range between 190 and 210 going back for a couple of years. Then we broke down from 170 to 190. Then we came back this year to the 190 to 210 range. We did have a bit of a symmetrical triangle that formed here on the IWM, which would indicate a breakout, and breakout it did. And then we had this big move last night in our insiders meeting, which is for alert subscribers at ewotrader.com only. We talked about this big move up, but we were right at 210 last night, and we said, will we get follow through today? And we did. And we actually closed above 210. Are we now starting a new trading range on the IWM? Are we going to move between 210, 230? What I'm just throwing a number out there because above 210, who knows where the new trading range might be. One thing that we do know for sure is the IWM is overbought now. Look at that separation from the 10-day moving average. So some backing and filling, I think, is warranted next week. The question will be, can we hold 210 if we move back down? Does that become support? What was resistance becomes new support. Will the 210 level act as support next week? That's what we need to see. But I don't think we continue this vertical stuff up. I do think we need backing and filling on the IWM. But holy cow, was that pretty wild to see the IWM move like that. Let's take a look at a chart of the VIX. And as we look at the VIX, we just are pegged to 12.5. We're just sitting here at this 12.5 level. And the market doesn't seem to want to go below it. A little bit of a concern here is this descending triangle, as I've talked about in infinitum as well. You don't look at a descending triangle as an indication of a break to the downside. Any triangle can break either direction. I've shown you enough examples of that over the weeks. But a reminder that we can drift lower here, even though 12.5 has been support for the entire year of 2024. We do have precedent where we've moved down towards 10 and even into single digits. I don't think it would be a big breakout move. I think if we move lower, it's more of a drift down, which could incorporate with a melt up in the markets. So we'll see what happens there. But it's amazing how it just seems to be stuck right at 12.5. All right, so let's move in and talk a little bit about the crypto world with Bitcoin. We did a live show today on the Hub Financial channel. You're watching this on the Elliott Wave Options channel. We talk every Friday. It's primarily crypto show. So if you haven't visited Hub Financial, go over to Hub Financial on YouTube, register there, and you can join us on Fridays for our crypto show. And we talked about all the things going on behind the scenes. The main thing is we said if Bitcoin couldn't hold 60,000, we're probably coming down to this level here around 52,000. And it would probably be rather quick because the move up from that level was vertical up to 60,000. And that's exactly what happened, back down. And another indication of what goes vertically up oftentimes comes vertically back down. Now we're coming back up and we're trying to test 60,000. Can we get back above it? We talked about the things behind the scenes that are going on. The German government putting a lot of Bitcoin back onto Coinbase. We have the U.S. government with some seizures from Silk Road. So there's been a whole lot of supply of Bitcoin come on. You could argue that it's being absorbed pretty well so far. What we'd want to watch is this level down around 50,000. If we were to correct down here and somehow break 50,000, then we would be down here around 40,000 rather quickly because that move up from 40 to 50 was fast. But so far, we're holding in this area. We're kind of trading through the 10-day moving average right now. But that really isn't as important as getting back above 60,000. We need to get back above 60,000. And if we do, then we start looking to see if we go up and test 70,000 again. Our crypto guru is saying that feels like we're still going to see prices higher on both Bitcoin and Ethereum moving into the end of the year. But I invite you to go watch that recording over on the Hub Financial channel if you are interested in the crypto world. Let's get into metals. we take a look at the SLV. We'll see here that we did have a nice breakout of the triangle. We posted that as a case study consideration last week in the Trade Finder, and some of you commented in the U.S. market update that you followed that, and that was a great move. You can see the big move up. Lots of stuff going on this chart. If you've been watching us, you know that. On SLV, we have the Wave 5 right here. We have two zigzag patterns. All of that Elliott Wave stuff converging in the same area, somewhere around 30, and we're getting awfully close to that area. So it does seem like a nice breakout in SLV. One of you asked how I could not talk about GLD in the last week's recording. So let's bring in GLD so I can show you that. And we are breaking out of a really nice symmetrical triangle here on GLD. This is more the breakout that you want to see, because this kind of tends to hold. Those big vertical breakouts are fun, like we had on SLV, but then you get a little more of a correction. But on GLD, just a nice breakout. I don't think we're done going higher on GLD, but we had sent this out as an alert to our alert subscribers at evotrader.com and our volatility portfolio on triangles. And so that's working out extremely well. And I do expect to see the metals continue higher as we do look towards those Fed rate cuts. So kudos to you for asking about that. Let's take a look at a chart of oil. And if we look at oil, I've mentioned this in the past, so I don't want to go through it again. It's kind of the poster child for corrective patterns within Elliott Wave, with this zigzag performing exactly to the rules, expanding triangle, break up to the previous fib level, come back down, go to the extended 161.8, held the B wave around the 61.8% fib level, and then we had this big move up. And now the question becomes, now that we've reached this A wave high in this big zigzag pattern, and when I bring that in, holy cow, I don't want to see USO up at 90. Is painful enough. If you go to our website at evotrader.com, you can see the cars that I drive, all big V8s, none of them fuel efficient. So it's painful at the gas pump. I thought maybe once we hit this 61.8% extension and backed off, maybe we might have a little more of a correction, perhaps a zigzag within this big C wave, complex C wave. We've recovered right back above the 10-day moving average, closed right on it today. Perhaps we still come back down. I'd like to see us come back down and test this 50-day moving average here. That's an area I'd like to see us correct to, but we may not get it. And goodness, if we break above this A wave high, we're probably off to that C wave extension. So oil being a little bit of a fly in the ointment, but the energy stocks caught a bid this week based off that. So that's an area that you might want to look at for the next week or two, if we can break above this 61.8% extension here on USO. But we'll update that next weekend and see how that plays out. Now, as we get into stocks of interest, we'll start with Tesla. And by the way, just as a reminder, every month this year, we're giving away each and every month a free subscription to our Level 3 portfolio. That's our three primary portfolios. Our AI-based impulse portfolio, which we had a one-day trade that we sent out yesterday that we closed today. That's primarily based on zigzags within wave threes, and it's AI-based, so they have over 300 data points that they infuse it with. So a great directional trading if you like shorter-term stuff. And then the volatility portfolio, which are the triangles that I talked about. We had the GLD in the volatility portfolio for triangles. And then we have an AI-based time strategy, which is more of an income-based strategy for things that are expected to stay in a trading range. And the AI gives us a score on the likelihood of staying in one standard deviation. Worth thousands of dollars. You can see it on our website. We're giving away one free each and every month this year. And all you have to do to register is post a comment underneath this video. I read every single comment. I respond to as many as I can, time and travel permitted. And with the holiday week and travel, I haven't gotten to as many from last week as I'd like, but just leave a comment and you're registered for this giveaway. All right, so coming back to Tesla, which is talked about a lot, and you guys ask about it. We had this quick move down. We got too vertical. Here are the rules again. nothing goes straight up forever, and what goes straight up oftentimes comes vertically back down. And isn't it interesting that we had the news yesterday that brought us back down from Tesla that they're going to delay the rollout of the robo-taxi a couple months from August to October. That brought us back down to the 10-day moving average, but we were able to close back above it on Tesla. So here's the reason we don't like the vertical stuff. We went right up to that resistance level from the end of the year last year, and then right back down to test the 10-day moving average and holding here. If you are bullish on Tesla, you'd like to see a little consolidation here, I think, underneath that recent resistance. Let's go sideways for a bit, a little more backing and filling. And then if we can break above this resistance area here, maybe we could be off to the races again on Tesla. But Tesla being back in everybody's questions on the Q&A from Trade Finder or alert subscribers, etc. But that's what's going on with Tesla. We take a look at NVIDIA. Some people were saying, oh, they got a little bit nervous yesterday, but no, it's right in that 45-degree angle that I drew last week. I don't think we're going to see these kinds of vertical moves that we did before. When you go through a big split like NVIDIA did, I've talked about this numerous times. Institutions heavily own NVIDIA, and when you get a 10-for-1 split like that, when the stock goes up, they tend to sell a few shares off, book some of those gains, but still maintain a position, and that just stops the stock from getting too far ahead of itself. And so we got a little bit up here and right back down, held the 10-day moving average, closed above it. I do think we look towards more of a 45-degree angle. I don't think the move is over in NVIDIA yet, but with the market rotation as evidenced by the IWM moving into small caps, I just don't think we're going to see the kind of craziness in NVIDIA that we've seen in the past, but that melt up scenario kind of makes sense for NVIDIA as well. You all ask about UNG, so we'll take a look at UNG. And natural gas had this zigzag pattern, looked like maybe something was going to happen, but look what we did. We went right up to that A wave level, and that held, and we moved down, and we've broken this B wave level here. So it doesn't look like anything too exciting going on in the world of natural gas right now. We're almost there. It seems like we're destined to come down and test this level here around 15 once again. That did active support from February, March, April into early May before we started the zigzag. But breaking that B wave takes that zigzag off, so we're going to get rid of that. We won't look at that anymore. And now we're down here in this area of 15. Maybe we can start some sort of a new move here, but we are below the 10-day moving average. You want to see natural gas get back at least above the 10-day moving average. But if you want to really look for a good long trade, you want to see it break above that 50-day moving average. So little caution here on UNG. If we were to break 15, then holy cow, we could go a whole lot lower. That would be, we haven't talked about it in a while, but that could be a Katie bar the door scenario if we don't hold 15. So now that we're back in this area, the thing to watch is whether or not we hold 15 and whether or not we can get above that 10-day moving average. And then I know I talk about India a lot because that's where the action has been. So let's look at the chart of India real quick. It just keeps going up. Seems like day after day, we just keep going up on the INDA. So whether you look at the INDA or the Nifty, but we are past 161.8% extension here. So we're going to go back to the same scenario that I talked about in the Qs in the past. Are we going to see this relabeled to a 3? Or is it going to be a rare move where the wave 5 starts to wane as it goes up to a 261.8% extension? That's a possibility as well. It does happen. There is precedent for it. But I can tell you, since trading Elliott Wave for my own personal trading since 2001, it doesn't happen very often. But it does happen. But we talked about the same thing in the Qs, and it relabeled to a 3. Goodness, is the INDA going to do that? Look, when we put the DMI on here, it looks pretty constructive on the DMI. So I would not be shocked to see this wave 5 relabeled to a 3 on the INDA. We'll keep an eye on that and see where it looks next week. And then you wanted to see the FXI, and maybe something's actually starting to cook here in China. It's been a while. They've been depressed for a while. We've gone sideways in this area around 26 or so. All the three major moving averages converging to the exact same spot. And now we're trying to break up just a little bit. You can see that we have separated on the two directional indicators on the DMI. The ADX is curling up, but it's got a ways to go. It's got to get above 20, and it's got to get above that negative directional indicator. So we can watch that next week and see if that occurs. So it is interesting that we are starting to break above this consolidation here over the past couple of months on FXI. So it is certainly something to keep an eye on, but you need to see that DMI give you some confirmation that wave 4 corrected right at 50%, good strong level to mount a potential run up to this wave 5 that the algorithm has labeled. So perhaps we do go there. But I just want to see that DMI give confirmation first before you get too excited about going long the FXI. But nonetheless, it is interesting. Thanks as always for spending some of your weekend with us. Hope you have a great weekend. Look forward to talking again soon. Take care, everybody.
If you like these recordings, I'd like to invite you to join our new Trade Finder Live, where each and every week we do a live webinar where we talk about the market, but we also go a little more in depth into the technical analysis system that we utilize to forecast where the market's likely going to go, and also to identify trading opportunities. Get your free subscription today. Take care, everybody.